Okay, hello, you trader nerds, and all of you at the University of West Georgia. Go, Wolves, go. Hey, listen, anytime my integrity is attacked, I am going to respond because I'm not a lover, I'm a fighter. So let's go see what somebody has said on one of my YouTube channels. I said, so this was on my video, the Sweet Bobby Hedge, how to hedge your portfolio against this Black Swan event. And Ezekiel says, proper attribution is the hallmark of integrity. I mean, you had to look that up. Don't you know? That's probably something you had to look up. People pay good money from as early as in 2017 for knowledge of this hedge by its creator. And that creator, sir, was not you. So I gave him a thumbs down. And I basically said, look, I give Ron Bertino credit all the time. Don't be a jerk. Don't be, a pansy weensy. You can't trademark a put-back ratio spread. The trade is older than Ron. Okay, so Ron did a 3-5. And if we remembered, why did I change the name of it and start calling it the Sweet Bobby Hedge? I called it that because Ron Bertino, rather than asking me not to use his trade, what did he do? He went to YouTube and tried to have my channel shut down. You remember that? All of a sudden, I got a warning and they took my YouTube channel down. Remember that? He goes, let's be clear here. The putback spread is as old as the hills, true, but the hedging technique of opening the short at -3 and then legging into the nearby longs, harvesting the short and rolling into new shorts is not your idea. You could have opened your discussion to this technique with attribution to anyone other than yourself, but you chose. You evil, fat bastard, you tried to call it the Sweet Bobby Hedge. I'm not being a jerk. I was informing people of what I see as someone creating the perception that an idea is their own when it is not. I never mentioned any names as to who actually created the idea. Perhaps RB did create it. I do not know for certain. Well, then how about go back into your little hole? And anyway, I told him that Ron reported my content. Anyway, just unbelievable. Ezekiel, how about this, dude? How about go trade your own dang plan? How about leaving me alone and questioning my integrity, attribution of its source? You had to look up attribution, dimwit. Unbelievable. I got enough idiots in my life. I don't know any Ezekiel over there pounding me against the ceiling, for God's sakes. Anyway, I'm okay today. How y'all doing? All right, so let's see how we're doing today. Let's see what the market's doing. Ezekiel, unbelievable. Like that's really your name. Who the flip would name their kid Ezekiel? All right. So let's see what the market is doing today. I'm actually good, y'all. I really am. I did take my medicines today. Y'all know I'm highly medicated. So let's see how we are doing here on the 2-minute charts. The E-minis are up 0.26%. I thought they were down a while ago. So we're up 13.5 points. Let's go over here, make that auto. And by the way, I got this from Don Kaufman. This isn't my chart, Ezekiel. I got this from somebody else, for God's sakes. So anyway, the cash open was here. We're below the cash open, but we are 0.26% higher. VIX, which is the fear index, is down to 13.38. The advancers over decliners is 159 and just kind of hanging out for lunch. And even though it's 2 o'clock, and the number of contracts are 3,800. So it's a little bit more than yesterday. And we got the inflation data out today. And I guess everybody's okay. Nobody's really panicking on the stuff today. Let's go to the big green monster. Hey, by the way, Ezekiel, I didn't come up with a big green monster either. A guy by the name of Blake Young did. And I don't understand it, but I use it, pal. How about that? Blow it at your backside. So anyway, the big green monster, we are fairly priced today, and everything's looking good. So, everything's looking really, really, really good. That's my doctor calling. I should answer that, I guess. So we expect that we're going to go back to this 51.23 level at some point, but we've got a pocket where volume has not traded here at about the 60 area. So we may test the 50-60. So if we don't go up, we're going to go down, or we're going to stay in between. That's where we are, but we are fairly priced. Notice that we are in a bull market, as you can see by the, where is this? Here we go. As you can see, the linear regression shows that we are going up and up and up and up and up and up. This is a bull market. So make your money, make your money. So let's see how our little account's doing today. And let's see, last time that you and I met, we were at $376,000. So today is 229.24. And this account is at, let me pull it up here because they won't let me show it on the thing anymore without showing the account number. So we are at 379,066.71, 379,073.03 now. So fire up the band, Rico. Not bad, y'all. We're at 14,929 on the year. We are right where we need to be, probably at 3.25%. Looks good. I mean, I'm just really good. So we've made $2,400 since last time. Let's look at what our Greeks and ratios are. Now, this is how we measure if our account's doing good or not. Remember, deltas are our speedometer, how fast we're going. So let's look at our account. Let's see if I can figure out which one it is. This one. Let's trade this one. Let's move that. Let's take this off. So there we go. We'll make sure we got it. So we are at 284 deltas. That means, ladies and gentlemen, that is the equivalent of us owning 284 shares of SPY in the account. That is SPY weighted. The VIX is 13. The theta, remember, theta is the amount of money that theoretically we should make. I like the angle of the linear regression channel. What about it, Stacy? Did you have something about it? Let's look at it. It's like at a 45-degree angle, isn't it? Just nice and up. 45 degrees. Love my linear regression. All right, so let's see what our theta is. Theta is the amount of decay that we have per day in the account, and is theoretically, the amount of profit that we should make in the account on a daily basis. Now, keep in mind that over time, as the market goes against us, we're only going to keep about 25% of this. But we are with a theta of 374. So let's put on 374. It's about the same thing we were last time, right? So we're at 0.10%. VIX is at 13. What is our buying power? Buying power is theta is our fuel gauge. So we got our speedometer, which is green, right? We're fine. We've got this, which is blue. So we need a little more theta. And then we've got our buying power, which is our tachometer. How much are we revving up the old engine? Hey, how many of you want to bet, though, even though Ezekiel was mad at me for copying someone else's trade, how many of you bet that Ezekiel is going to watch today's program? Thank you for watching, Ezekiel. You're adding to my bottom line. All right, so let's do, let's see, what are we doing? He's getting me all in a tizzy. Our buying power. So let's go to our positions. We don't want to count our bill because we have 2,340 shares of bill, 2,340. And tomorrow is the day that we get ex-dividend, right? Tomorrow's the ex-dividend date, I think, on that. Normally it's on the 1st. So we should make another maybe 40 cents per share with our 2,340 shares of that. So, and you'll see our net lick go down tomorrow, right? We've made 49,000 in these accounts. We're up $5,000 on the day. We're up 862 in this account. And so our buying power is 144,277. 144,277. So everything looks really good. Remember, I can go up to 50% buying power. So we're using 38% buying power. And let's go to our position sizing. We should have 15 total positions on. How many do we have? We have 14 nakeds and 16 put debit spreads. So that's right at 15. This is really, really good. So let's see if there's any of the trades that we're supposed to take off today. Aha, we've got a close here on something. How about that? That's on our short hedge. Let me clear this all out, y'all. Make this a little easier for you to read. So let's do this, and let's do the blanks and okay there. So this debit spread that we bought is going to expire out of the money. So we need to close it. Today's this last day. So we'll go 0, close it. And the close date will be today, which will be 2/29/24, which is my mama's birthday. God rest her soul. She was a leap year baby. She died like when she was 18 years old. No, I think she was 21 or so when she died. She only had 21 actual birthdays. So that's good. So that is going. And where did our close signal go? I thought we had a close signal. Why did that say? Oh, short hedge. It's got 28 days to go. We can close that in 7 days. I'm not sure why that said. Hold on a second. Short hedge less than 21 should say that. Okay, yeah, not sure why we got the close signal on that one a while ago, but we can let that go another 7 days. Close it around 21 days or so. All right. Oh, I know why. The long hedge is 14 days. Okay, that's fine. So does anything say that we need to close it? No. Let's see about our short naked puts. We've got 61 days left in that trade. Here's our oldest ones. Our naked put here is down to 28 days. So we can probably let that go for another day or two and close it next week when it's at 21 days. Yeah, that's what we'll do. So let's put on a new trade today. And our position sizing chart tells me that I normally put on one tranche per week. But at the same time, y'all, I'm not using a lot of buying power. I think I'm going to do two today. I think I'm going to do two. I just feel like ramping up the risk a little bit. So let's go to the platform, make sure we're trading the right account. And let's look at a 111 today. We've been doing 111s in the E-minis. This is the S&P 500 futures. And remember what we do is we go out to 120 days. So we do have a 120 day today. How about that? Rough. So we got to 120 and we buy a put debit spread that is at the 25 delta or so. So we're going to buy this and we're going to do a spread, sell that. What does that look like? Well, let's see what that looks like. Analysis. Let's just do the trade. Look at this, y'all. This is a put debit spread. And if you did it all by itself, you're paying money that's going to lose. I'm going to lose my, $417 in this trade. But look what happens if the market comes down. We make $2,082. As long as the market goes down, we make that $2,087.50. Looks really good. So let's put that trade on. And the only problem is this by itself has only got a 32% probability of success. But again, this is our hedge, right? And we said we wanted to do two contracts. Good. So let's sell that or buy this. Come on, baby. Don't embarrass me in front of my friends. Where's my working stuff? Come here. There we go. Let's move it up. Replace order. We'll go up to the mid price of 835. Nothing. Got to work it again, y'all. Work the orders, make it less advantageous. This is a debit, so I'm going to pay some more. There we go. We got filled at, 835? What do we get filled at? 120 days. We got filled at 835. And this is the 4950, 4900s. 4950, 4900s. So let's put those in. 4950, 4900s. And this was put on for, what did I say, 835? Y'all correct me if I'm wrong. My memory is very short. All right. Yes. We got two contracts of that. So this is a put debit spread. This will be our 17th one of the year. And let's do puts. This is a debit spread at 120 days, and we put it on 2/29/24. Love getting an extra day. Isn't that cool? All right, so now we got to sell two ES puts, sell two, and we'll call this a naked put 17. Puts naked 120, 2/29/24, and we'll see what we can sell these for. All right, so let's do the put debit spread, trade, and table. So we got those in. So now we're going to go and sell a 10 delta put right here. These 4650s. 10% probability of being in the money for 30, 50. I said we're going to do it for 30. Let me clear this out. 30, 50, 10% probability of being in the money. 30, 50. We're going to try 30, 75. And again, we're doing 2 contracts. Let's see if we get filled. 46, 50s. Nothing. Jack, squat, crap. Do nothing. Sorry. All right, let's go back to 30, 50. Make it less advantageous. We're selling it. So, ta-da. Uh-oh. Now I'm using over 100% of my buying power. But it says I've got 9,000 in buying power left. So we'll see. So we just sold the 4650 at 3050. 4650 strike. 4650 at 3050. Now, y'all, I tell you what I want to do. And the reason I want to do it is because of Ezekiel. I want to put on a sweet Bobby Hedge today because my account's doing good. We're up almost, 4% on the year. Let's see what we're on track to do. Remember, I want to do 20%. So today is let's see, what day of the year is it? Google. What day of the year is it? It is day number 60. So today's number 60 out of 366. And we're up 3.25%, was it? Let's see. 3.25%. Let's do that in math. 3.25 divided by 60 is that much per day times 366 days in this leap year equals, well, we're not really on track, are we, for 20%? We're right on track for 20%. I started to say we were overperforming and I was going to put a hedge on, but I don't think I'm going to do a hedge today. I don't think I'm going to do a hedge because this is right on track. We're right on track for a 20% return. Now, remember, ladies and gentlemen, if you can do a 20% return per year, you are one of the master traders of the universe. You are awesome, my friend. And this particular strategy did 24% in 2022 when the market was down 20%. And then in 2023, we were up 20% when the market was up 24%. So I believe, based on my calculations, naught and naught is naught, we can probably do 20% per year with our strategy, doing the 1-1-2 or the 1-1-1. The only difference is you're selling 2 puts at 5 delta here, you're selling 1 put at 10 delta here, and yeah. So, I think 20% is really, 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 really good. So let's say that let's say that some of you guys are in here that are young, right? Let's say that you have a portfolio. Let's just see if you could do 20%. Now, here's the thing. The rule of 72. Make sure everybody knows the rule of 72. You take 72 and divide it by your annual return, which means 70 into that would be 3.6 years to double your money. That's how long it would take you to double your money if you could do 20% returns. So let's see if we've got our little time value money calculator. You want to? Let's see, compound interest. So financial tools, compound interest calculator, which we need to play with a lot. So let's say you started out with $10,000. Can you do this strategy with $10,000? You can. And let's say that you just go $333 a month that you put into your account, right? That's on a $40,000 salary, that's 10%. And let's say that you are going to do this for those of you that are in 20s. Let's say you're going to do it for 40 years. You're 24, 25, you want to do this for 40 years. And your estimated interest rate is 20%. How good are you going to be? Already, let's see, in 40 years, you're going to have Now, y'all, listen. Are there going to be years that you lose money? Probably. Are there going to be years that you don't make 20%? Yes. Are there going to be weeks or months or years that you make 40%? Yeah, probably. I believe so. So in 40 years, starting off with your $10,000, you would have $44 million. Fire up the band, Rico, would you? I don't know either, Mama, but I tell you what, 44 million is a lot of smackaroonies. Isn't that cool? God, can you imagine if you did this for 50 years? We're just dreaming here, right? So if y'all were 50, y'all did it till you 70, how much would you, and you could spend some of this along the way, right? You'd have $272 million. Now, I know Ezekiel's going to get all ticked off and he's going to be saying, well, Bobby, this is assuming linear returns and blah, blah, blah. And it's not going to be, I know. Ezekiel, blow it out your backside, dude. We're on the path to greatness. We're on the path to doing something really, really, really special. And this is portfolio management, y'all. You get in, you look at your deltas, you look at your theta, you look at your buying power. Those are your three gauges that we look to make sure how your portfolio is doing. And then you sell options. Now, we bought options today as a hedge, but what we're trying to do is we're trying very hard to sell options at a high probability of success. So let's go through the plan again. What do we do? Now, all of you in your thing said, oh, I want to buy options because no, you don't, because that's when you lose money, y'all. We sell options premium. We get premium for selling options. We're providing insurance to those who want it. And we do this with a high probability of success. So the trade that I did today will have a probability of success of 90% or more. Right? Then what do? Well, we allow theta to decay, and this creates profits into our account. The options decay because you got to buy them back at some point. So remember the apple? Apple starts off nice and good, and it rots over time. Days go by. This thing rots. Looks like a little tick, doesn't it? It's like a potato with legs. Very strange. Anyway, so theta decays, and you all of a sudden buy back the core of the apple. There's nothing left. You buy that thing back for 20 cents that you sold for $1 or something, and you make the money. Then we manage chaos. Manage chaos when the market goes against us. Got to know what to do. And then finally, you just rinse and repeat. 5 steps to successful portfolio management. This, ladies and gentlemen, it may seem simple, or you may not have no idea what I'm doing, but hopefully you'll see me doing the same thing week after week after week, and you'll realize this is portfolio management. Y'all have a good week. Y'all have a test on Tuesday, and I will see the rest of y'all tomorrow.